Welcome once again to Financial Accounting. In the third part of Chapter 1, we will introduce the business cycle and learn how to write down business activities and transactions in the form of the accounting equation. Once again, these concepts are extremely important to understanding everything else that you will learn in the course. Let's start by learning about the business cycle and transaction analysis. I developed the illustration on this slide to summarize the three major types of business activities that all businesses carry out: financing, investing, and operating activities. I hope it is helpful to your understanding of how the terms we are discussing relate to the real business world. To remain in business, the first thing a company must do is get financing. The two sources of financing are the company's owner, we call that equity financing, and creditors. We call that those liabilities or debt financing. The company uses the money it gets from financing activities to pay for resources such as land, buildings, computers, and equipment in order to operate the business. We call these investing activities. Investing activities are the acquiring of and disposing of assets that an organization uses to make or buy and sell its products or services. It's operating activities, in other words. Operating activities are what the company does for its business. Operating activities result in revenues being earned and expenses being incurred. Remember that revenues minus expenses equals net income. Once a company is earning money from operating activities, it may repay its owners and lenders and put money back into the business. For additional information about how business activities affect the accounting equation, please refer to Appendix 1B on page 28 and page 29 of your textbook. Business activities include exchanges of products and services within a business or with a company's suppliers, creditors, owners, or employees. To write in the language of accounting, we must decide whether a business activity affects the accounting equation. We use transaction analysis to help us identify and classify what exactly a business has exchanged. It's important to remember that exchanges of promises, for example, I promise to hire you next week if you promise to work for me, do not affect the accounting equation. Something with economic value actually has to occur or be exchanged for a transaction to be recorded in the accounting records. In Chapter 2, we will formalize how to reflect business transactions in the accounting records using debits and credits, journal entries, and so forth, but for now, I want you to get used to thinking about how transactions affect the accounting equation. Remember, the accounting equation always must remain in balance, no matter what. Transaction analysis is simply a thought process accountants go through before recording anything in the accounting records. We ask a series of questions about whether a transaction actually occurred, what was exchanged, and we describe the impact on the accounting equation. Because the accounting equation must always stay in balance, it is important to remember that every transaction affects it twice. This is called the duality of effects. For example, assume equipment is purchased in exchange for cash. Equipment is an asset and increases. Cash is an asset and decreases. The accounting equation remains in balance because the increase in an asset offsets the decrease in an asset. Please ensure you understand this concept. In the next series of slides, we'll discuss what was exchanged during the period by Scott Company in the transactions outlined on this slide. We will also examine the impact of these transactions on the accounting equation. And in Part 4 of this presentation, we'll see how the transactions are aggregated to create financial statements. Keep in mind that transaction analysis is just a thinking process to determine how a transaction affects the accounting equation. We are not using formal accounting techniques yet. Please make time to carefully review the comprehensive Need to Know on page 25 of your textbook. It is an excellent summary of the chapter concepts. Sally Scott invests $20,000 cash to start a new business and receives common stock in exchange. Here we show the increase in the asset account cash and the increase in the equity account common stock by $20,000 apiece. Our basic accounting equation is in balance. Assets have a total balance of $20,000 and liabilities plus equity have a total balance of $20,000. Let's move on to the next transaction. S. Scott Company purchases supplies with $1,000 cash. There is a $1,000 decrease in cash and an equal increase in supplies. The total assets are still equal to $20,000, but are divided now between cash and supplies. There is no change on the liabilities plus equity section of our books. The company purchased equipment for $15,000 cash. Cash is reduced by $15,000 and equipment is increased by $15,000. The balance in our cash account is now $4,000. We have a current balance in supplies of $1,000 and in equipment of $15,000. The three asset accounts still total $20,000. Once again, there has been no change in the liabilities plus equity side of the equation, and our books are still in balance. The company purchases supplies of $20,000 and equipment of $1,000 on account. We acquired $1,200 in assets without paying cash. Cash did not change, but supplies and equipment increased. The total on the asset side of the equation is now $21,200. If you use a credit card to purchase gas for your car, you receive an asset, gas, and incur an accounts payable to the credit card company. In this case, the balance in liability accounts is now $1,200 and the common stock account balance is still $20,000 and the accounting equation is still in balance. The company borrowed $4,000 from the bank. The asset account cash is increased by $4,000 and the liability account notes payable increased by $4,000. The asset side of the equation now has a balance of $25,200. The liabilities plus equity side of the equation has the same total balance of $25,200, so our books are in balance. Notice that the sum of all assets, $25,200, is equal to the sum of liabilities, $5,200, plus equity, $20,000. The accounting equation is in balance as required. To this point, we have not looked at transactions involving revenues, expenses, and dividends. In the next few slides, we will address these accounts. Remember, increases in expense and dividend accounts decrease equity. S. Scott Company provided $3,000 of consulting services and received payment immediately. Our cash account increases by $3,000 to a current balance of $11,000. Total assets now amount to $28,200. The revenue account also increased by $3,000. Recall that from our expanded accounting equation that revenues increase equity and expenses decrease equity. The total of our liabilities plus equity is now $28,200. Unfortunately, companies have to spend money to make money. Let's think about what happens when the firm pays their employees $800 for work performed. What will be the effect on the accounting equation? You probably got the decrease in the cash account, but did you remember to show the increase in expenses as a decrease in total equity? Our expanded equation is getting to look more and more complicated. But don't worry, practice will help you fully understand the recording of these and similar transactions. and our books are still in balance. There are two reasons for an investor to buy stock in a company. First, they're hoping the stock becomes more valuable and they can sell the stock for a gain. Secondly, they buy stock to earn dividends. If you've been paying attention to the financial news over the past couple years, Apple has paid record dividends to their lucky shareholders. I say lucky because their stock has also become more valuable, giving many shareholders gains too. In our example, the firm paid dividends of $500 to the shareholder. Note that dividends act just like expenses in the sense that they reduce equity. However, they reduce retained earnings directly. They are not an expense and will never be shown on the income statement. The asset account, cash, decreased by $500, and the equity account, dividends, increased by $500. Increases in the dividend account reduce total equity of the company in the same way that expenses decrease equity. The final balances show that total assets are equal to $26,900. The total of the liabilities plus equity has the same balance. During the next part of the chapter, we will see how these total amounts are reflected in those financial statements. But first, I've prepared a little mini test for you to test your knowledge. Can you answer the following questions? State the accounting equation. Cash, accounts receivable, and land are examples of liabilities, true or false? What are the four types of accounts that make up total stockholders' equity? Net income is equal to revenues plus expenses, true or false? What are the two main components of retained earnings? Name the four financial statements, the order in which they are prepared, and what type of accounts they report. Which financial statement reports amounts at a particular point in time, a certain date? The answers to the last two questions may be found in your textbook. We will also be talking about them in our next video presentation for Chapter 1. If you've read the textbook and are reviewing the practice materials in the book and in Connect, you should be able to. An additional thought before we close for this session: the accounting equation is not a formal part of the accounting cycle or system. However, it is a fundamental rule of how the accounting system works. We will translate transaction analysis and the accounting equation into the language of accounting in Chapter 2. Okay, so that's it for now. See you in our upcoming discussion about financial statements. And good job, just one more section to go. Talk to you soon.